Welcome to this explainer. If you've been keeping even a casual eye on the markets lately, you know that performance numbers are just flying everywhere. It can get pretty noisy, right? So today, we're diving into a fascinating data set from Stock Market Diaries to separate the signal from the noise, specifically focusing in on the latest mutual fund performance leaderboard.
Okay, let's dive into this. 25.2%. I mean, just let that number sink in for a second. That right there is the massive 6-month return achieved by the absolute top fund on our list today. When you're thinking about wealth creation, seeing a short-term jump like 25.2% in just half a year, that is incredibly alluring. It's exactly the kind of shiny number that has people instantly grabbing their phones to open their investment apps. But while this figure is undeniably impressive, no doubt about it, treating it as the whole story, well, that's actually one of the biggest traps in investing. So let's pull back the curtain and look at the full leaderboard to see exactly where this came from and who else is trailing right behind it.
All right, here we go. The top 10 mutual funds that delivered these crazy strong 6-month returns. And the patterns here, honestly, they're fascinating. Sitting at number 1, as we just teased, is the Bank of India's Small Cap Fund at that staggering 25.2%. But right on its heels, literally practically tied, is the Trust MF Small Cap Fund at 25.1%. Now pause for a second and just glance down the rest of this list. You spotting the trend yet? Look at number 6, the JM Small Cap Fund at 21.9%. Number 7, Motilal Oswal Small Cap Fund at 20.9%. And then Union Small Cap Fund sitting at number 9 with 20.3%. Literally half of this entire top 10 leaderboard is completely dominated by the small cap category. But wait, that's not the whole story. We're also seeing this explosive surge in very specific sectoral funds. I mean, look at the HDFC Defense Fund coming in third at 22.9%. Defense and energy are clearly having quite a moment right now, for sure. We've got healthcare making a really strong showing too, with the Kodak Healthcare Fund at 22.7% and the HDFC Pharma and Healthcare Fund closing out the list at 19.8%. We even see energy and totally new market entrants making waves, like the Grow BSE Power ETF Fund of Funds and the Edelweiss recently listed IPO fund. So the sheer dominance of small caps and these highly specific sectors in generating these short-term spikes is, well, it's pretty undeniable.
And this brilliantly illustrates a really fundamental tension in investing. Let's just take a step back from those huge percentages for a minute. What we just looked at on that leaderboard, those are short-term market trends. That's a snapshot of what's been hot over the last 180 days. And sure, short-term performance definitely highlights where the market's momentum is at right this second, but here is the reality check. Mutual fund selection absolutely must be based on your long-term financial goals, your personal risk tolerance, and how it fits into your overall portfolio. Chasing recent high returns, it's a really dangerous game. That leaderboard is a perfect reflection of short-term market dynamics, but building real, lasting wealth requires a completely different mindset. You really have to bridge the gap between what's trending today and where you actually need to be financially a decade or more from now. So how do we actually do that, right? If we aren't just blindly picking the fund with the highest 6-month return, what on earth should we be looking at? Well, our source provides us with a really phenomenal, comprehensive checklist. Let's deliberately slow down for a second and walk through what genuinely matters. First up, the investment objective. Does what this fund aims to achieve actually align with why you are investing in the first place? Second is the fund category. As we just saw, small cap and sectoral funds dominated recent returns, but does that specific category actually fit into your broader investment strategy? Then we have the risk profile. Those sky-high returns we saw usually come with equally high volatility. You have to ask yourself, can you actually stomach the dips? Next is the expense ratio, or TR, which we're going to double-click on in just a moment. We also need to look under the hood at portfolio quality, like what actual stocks is this fund holding, and who's making those decisions. That brings us to the fund manager's track record. Are they experienced? Have they been around the block? And finally, long-term consistency. Have they performed well over 5 or 10 years, not just the last 6 months? You really have to treat that initial leaderboard as a bit of a cautionary tale of short-term bias. This checklist right here, this is your actual roadmap for smart investing.
Now, I want to pull one specific item out of that checklist because it gets overlooked way too often, and that is TER, or the total expense ratio. Let's completely ditch the jargon for a second. Basically, this is just the measure of the total costs associated with managing and operating the fund. It's incredibly easy to ignore this when you're completely blinded by a 25% return. But why does this matter so much? Because every single percentage point that goes toward management is a point siphoned directly out of your compounding returns over the long haul.
If you have a fund that had a killer 6-month run, but it carries a massive expense ratio, those operational costs are going to seriously eat into your actual wealth creation. It's essentially the hidden cost of investing, and keeping a close eye on it is an absolutely vital part of your personal finance strategy. Which brings us to the golden rule of investing, highlighted really powerfully by Stock Market Diaries. Short-term returns do not guarantee similar performance in the future. I literally cannot emphasize this enough. The figures we looked at today are strictly historical. They are shared solely for educational and informational purposes, purely for comparison and learning. Under no circumstances should those top 10 funds be viewed as recommendations or endorsements to go out and invest. The market shifts, sectors rotate, and today's absolute top performer, well, it can easily become tomorrow's biggest lagger. Past performance is simply not indicative of future results.
So, the crucial point is, how do you actually protect yourself and make informed choices? Well, you read the documents, specifically the SID and the KIM. That stands for Scheme Information Document and Key Information Memorandum. These are absolutely essential scheme-related documents that detail all the fund operations and risks. And yeah, I know reading financial disclosures is nobody's idea of a fun weekend, but before you put a single dollar or rupee into a fund, you have to read these to understand exactly how the fund operates, what it invests in, and critically, the specific risks involved. You have to do your own research, what the investing world calls DYOR. And beyond just reading, honestly, the smartest move you can make is to take these documents, take your research, and consult a qualified financial advisor before making any investment decision.
Because at the end of the day, all mutual fund investments are subject to market risks. Please, always read all scheme-related documents carefully before investing. This whole explainer today is really about shifting your mindset. We started off by looking at these exciting, high-flying market trends from a stock market diary perspective. But true wealth building, it requires structured, long-term personal finance planning. It's all about relying on financial education, really understanding compounding, and making smart, informed choices rather than just giving in to impulsive reactions based on a flashy 6-month leaderboard.
As we wrap up this explainer, I want to leave you with a direct question straight from our source material today. Think about everything we've just discussed, the sky-high returns of small caps, the hyper-specific focus of sectoral funds, and the absolute necessity of long-term consistency. So ask yourself, when you look at your own portfolio right now, are you actually investing based on a solid, long-term strategy, or are you secretly just chasing last month's small-cap winners? Take some time to reflect on that, do your research, and invest smart. Thanks so much for joining me on this explainer, and keep learning.